let's rip into the show, firstly starting with the US data, and we'll start with the inflation story there. And this is very much a story about the first remnants of sticky inflation. So we saw annual inflation rate in the US unexpectedly edge up to a reading of 3.2% in February compared to 3.1% in January, and above the market forecast of 3.1%. Energy costs dropped much less than expected, negative 1.9% versus negative 4.6% in January. Meanwhile, prices increased at a softer pace for food, 2.2 versus 2.6, shelter 5.7 versus 6%, new vehicles 0.4 of 1% versus 0.7, medical care 2.9% versus 3%, and costs were steady for apparel, which was basically a reading of 0% versus 0.1 of 1%. Cost declined in used cars and trucks, negative 1.8%. So that's in disinflationary territory versus negative 3.5% as well. And prices continue to rise sharply for transportation. This is the big one in terms of 9.9% versus 9.5%. In monthly inflationary terms, we saw it rise by 0.4 from a reading of 0.3 of 1%. And that was driven by shelter and gasoline contributing to over 60% of those increases. So naturally, that's flowing into that transportation read there as well. In some good news, core inflation eased to a reading of 3.8% from 3.9%. However, compared to forecast of a result of 3.7%, these weren't great numbers, were they, Evan?
No, and you've highlighted that last bit. So, I mean, the chart that you've got on screen, if you're watching this on the YouTube channel, you can see this is what we refer to, as you said at the start, sticky inflation. You can see that basically since June last year, the month-on-month figures for the year-on-year read are now sort of bubbling between 3.1 and 3.8%, depending on which one you want to look at. And the chart that really catches my attention is this one. And so those of you listening, what this shows is just how hard it is to really impact service inflation. And that's the real drag here in terms of keeping inflation high, about this stickiness, because services involve people, you and me working. It involves, the overall expenditure of people as well, the wants for things like, as Ben highlighted before, travel and transportation. They all fall into services, and they are showing signs that they are still well and truly above where they need to be. Because unlike here in Australia, where we want a band of 2 to 3%, the state needs it at 2. So we're still talking to almost double where they need it to be. And that's, again, this concern that's starting to filter in that, yes, inflation is moderating. Yes, goods inflation, you can see, is back to basically next to nothing in terms of price increases. But services, and the US is a service economy like we are here in Australia, is dragging its feet. And that is why inflation, although it's moderating, is now getting caught at this really sort of in-between period where, unfortunately, prices are still growing, not at the level they were back at the end of the COVID lockdowns, but at a rate that is still probably too high to start talking about rate cutting in the near term.
Evan, that's a really good point, and it's a nice segue into where interest rates are going. So we know currently that the benchmark interest rate in the US currently sits at 5.5%. Now, we don't get, this is the big story, right? We get the Fed decision this Thursday, so we're going to learn a lot more about that. But we did get a little bit of an insight into Jerome Powell's thinking and the Fed chairs, the Fed board's thinking about what's going to happen. They do a semi-annual monetary policy report to Congress, and during that particular presentation, he reinforced that the economic outlook looks uncertain and ongoing progress towards that 2% inflation objective is not assured, and there are risks of reducing policy restraint either too soon or too late. So this is that sort of narrow path that's becoming a bit of a theme both here in Australia and also overseas. So effectively meaning that they will continue to make live calls at each meeting based on the data. So obviously, with it just around the corner, Evan, what's your read in terms of what you think the Fed will do with rates?
Yeah, so I want to go through a few things with rates and to point out, first and foremost, we need to understand that the current rate hiking cycle in the States is the third highest in the last 45 years. So before that, the two strongest were happening in the 70s in terms of the speed and veracity at which they went. They were during stagflation, we had the oil crisis, we had a couple of recessions, and all these other bits and pieces in between. So that's first and foremost that needs to be out there. But at the same time, it is very strong. It is clearly restrictive. We have seen it starting to have impacts that you need to want to see, which is inflation. But what you're alluding to there, Ben, is even the Fed itself is very confused about what's going to happen this year, next year, and 2026. The market, too, is also very quickly and rapidly changing its views on where rates are going and at what speed. On Thursday, for us here in Australia, we will get an updated version of what they refer to as the dot plot diagram. They are very good at their communication. Part of the review that we had for the RBA is around communication. Unfortunately, they're not going to do this, but that's okay. What it is it actually has every single member on the FOMC board. So that's the Federal Open Market Committee board, which is their overall committee that decides their interest rate numbers. Each member has to tell you what they think rates will be over the next 3 years, plus what they refer to as the longer run average. And each one of those dots on screen, if you're watching this, is a member. And what I want to show you from this perspective as well is that the chart that I have at the moment is only for December because they haven't given us an updated dot plots. We get that for March. So this will change. But I do want to clearly highlight that in December last year, the expectation from the market was that come December this year, the US Federal Reserve's cash rate, as we refer to it, or the federal funds rate, was going to be below 4%. That was the expectation all the way back in December. Now, the closest read we've got, which was last Friday, the expectation for the end of this year is for the cash rate over there to be at about 4.85%. That's a full percentage point difference. And that is off exactly what Ben and I have just talked about. Inflation's moderating, but it's sticky. Growth has been better than expected. Employment's been slightly better than expected. And that maybe the speed and unwinding of this has been slightly overdone with regards to market expectations. And that's what we want to see now is that if it is slower, it is going to have that unknown effect that Jay Powell's talking about.
Oh, well summarised, and I think it is going to be fascinating to see where that goes. All right, let's take a look at the remaining data that we always try to focus in on for the US and our international markets as well. We'll start with the unemployment rate, and we saw the US unemployment rate rose by 0.2 of 1 percentage points to a reading of 3.9% in February. Now, this is touching the highest levels since January of 2022 and surpassing market expectations of a 3.7% result. Now, the number of unemployed people increased by 334,000 to 6.5 million. The labour force participation rate was 62.5% for the third consecutive month, and the unemployment to population ratio was little changed at 60.1%. Looking at consumer confidence and sentiment, we saw the University of Michigan's consumer sentiment for the US was revised lower to a reading of 76.9 in February, from a preliminary reading of 79.6 and compared to 79 in January. Now, remember, that's pessimistic versus optimistic, right? So a reading above 100 is optimistic as opposed to pessimistic. So the gauge of expectations was also revised down to a reading of 75.2 from 78.4. The current conditions sub-index was also revised lower to 79.4 from 81.5. And most importantly, back to the sticky inflation story. Inflation expectations for the year ahead increased slightly to 3% from 2.9%. And the 5-year outlook for inflation was at 2.9%, but their target range is 2%. So, that is obviously consistent with their last couple of months as well. So there is certainly, from the consumer's point of view, they're thinking inflation is going to hang around for a little bit longer. How is that correlating into retail sales? So our month-on-month retail sales figures show retail sales in the US were up 0.6 of 1% month over month in February, following an upwardly revised 1.1% fall in January. Now, this was below market forecasts of a 0.8 of 1% gain. The modest increase combined with the larger decline in January suggests the potential slowdown in consumer spending, and that consumer in America is so important to their economy. Then we have a look at retail sales year on year. They increased by 1.5% up until the end of February. Now, for context, that compares to the average of 4.8% from 1993 to 2004. Now, that is really showing the slowdown of consumer spending that we're currently seeing here right now. And obviously that's on the back of higher interest rates out of the US. Turning our attentions to the business confidence data, and we see the ISM manufacturing PMI in the United States fell to a reading of 47.8 in February from a reading of 49.1 from the previous month. Now that's firmly below market expectations of 49.5 to the point of the 16th. It points to the 16th consecutive period of declines in manufacturing activity. Now, we talked about pessimistic and optimistic at a reading of 100. In these PMI indexes, it's anything above 50 is actually growth. Anything below that is basically seeing manufacturing declines. New orders swung to contractory territory of a reading of 49.2 versus 52.5 in January. Prices rose for a second straight month, 52.5 versus 52.9, albeit at an eased pace amid more expensive transportation equipment, chemical, computer, and electrical products. In turn, the fresh downturn in consumer demand is also showing up in a decline in employment levels for the fifth straight month. So this is a really good indicator in terms of what's actually happening when businesses slow down, employment start to rise, and that is unfortunately the hard truth of what slowing the economy does when you touch with interest rates. So what's your takeaway generally around where the US currently sits, Evan?
Yeah, so the business confidence numbers and the business data is always the thing to really look at because it's so granular and it's forward-looking in terms of what it is. It's really, really good, rich data for people like you and me. And you highlighted it already. What really catches my attention is orders are down, but prices up. So that is the inflation story again. That's the sticky inflation problem that's inside of it that we continue to see. Despite all this, expectation is that price is still moving up. Then you also highlighted the consumer. And the consumer having that inflation psychology, which the RBA was introducing to us over 18 months ago, shows that, again, even the consumer expects inflation in the States to be higher than what they need it to be. And getting to a point when you start hearing that 5 years out, that's acceptance. And that would really send the shutters up a lot of those sitting around that FOMC meeting that the consumer is actually accepting inflation at that rate. The final point on that, just to highlight, don't forget the difference and why compounding is the problem here. At a 2% inflation rate, 5 years from now, that $1 is about $1.12, $1.13. 3%, it's $1.17 to $1.20. And that's their concern. That is such a difference in terms of the amount of money needed just to stand still because of inflation. That's why they need to get it lower. And that's the big takeout still, is that there's still enough in there to show that the US consumer and business is still very much worried that inflation is going to be here for a fair while to come.
Oh, it's a beautiful point that talks about purchasing power. Ultimately, what we're saying there is a higher inflation level reduces purchasing power, which ultimately reduces standard of living. So a great little segue there. So